G'day, Johnny. Great question, mate. So what if you're not on a fixed income on a weekly basis? I'm going to show you how our cash flow structure allows you to treat yourself as if you had a fixed income and why this is important when you're creating systems for building wealth. So let me turn the camera around and show you how this works. Okay, so we have our cash flow structure here, the hub structure, which is our personal cash flow structure, and it is broken down as follows. We've got our hub account, which pays for all of our fixed expenses, mortgage, rent, bills, groceries, anything that's a necessity of life. Your spend money, your partners spend money, which we automate weekly in order to ensure that you have the ability to maintain a great lifestyle, but we can also put a cap on that spending. We've also segmented lumpy bills that don't come monthly, holidays that we can save in advance for, war chest for unallocated surplus, and our allocation of surplus into our short, medium, and long-term buckets. Now, this works assuming that we have a set amount of net income that does not reduce each and every single month. If there is volatility in this structure, we cannot automate it, which means that you are not going to have transparency around your cash flow, which means that you are typically not going to make the best decisions, or you are going to waste decision-making capacity using decision-making fatigue, because we need to make sure that we have confidence around all of this working. So what happens if we don't have a fixed income? Well, we need to actually create a layer above this. Now, this layer is on the assumption that you are running a full business. If you are a subcontractor or you've got high commissions, you don't necessarily need this level of complexity. I'll talk you through exactly what we've got. So most businesses have volatility, okay? And we manage this by having what we call the business hub. This is the equivalent of the hub account for the personal cash flow, but this is for the business. And all of our revenue comes into this business hub, okay? We don't eat from this hub account. We need to ensure that all income comes in and we distribute that proportionally. So the first thing we segment for is our GST and our sales tax. We want to put aside 10% for GST, even though you may not pay 10% GST because you're claiming an expense for things that you've incurred GST on. It's going to be a good forced savings for you. We then put aside money for cost of sales, subbies, suppliers. We want to make sure that we work out what fraction of your all income received should go across to cost of sales. So therefore we can determine exactly how much we need there. This determines what we call our real revenue, or what others call our gross profit. We then need an account for OPEX. This is for your fixed expenses, such as your employees, rent, bills, etc. Owner's pay, this is where you pay yourself, your number one employee. Tax, PAYG, super corporate tax, and then our profit, because you deserve to get 2 paychecks because you take risk as a shareholder. Now, the idea is we determine a percentage of all revenue that goes into all of these buckets. And I want you to imagine these buckets as a water jar, okay? We want to make sure that we're accumulating enough water in these water tanks and we're never depleting them down to zero. So we always are keeping a buffer in here. So what we do is we set up an automated transfer each and every single month or week, whatever you prefer, from your owner's pay account, which gives you consistency in the personal hub structure. So let's say, for argument's sake, for you to fill all of these buckets and have surplus of 20%, we need to have 10 grand a month coming in. So what we do is we automate 10 grand a month from this owner's pay account into your hub structure, so that can basically be completely automated. And then what we need to make sure is we've got enough income coming in from the business hub after filling all of the other buckets to ensure that this account is growing by at least 10 grand a month, ideally more. Because if it's growing by more, it means that we're building a mini war chest for when there is volatility in terms of your income and expenses. Now, you may have volatility in terms of your income. Let's say some months you have 10 grand, some months you have 12, some months you have 5, whatever that might be. I want you to work out what is the historical average of all of that incoming. So you can work out typically month on month, what is the volatility of the variation. Second, we need to work out how much you need to fill all of those buckets and have a surplus, ideally of at least 20%. Thirdly, we want to work out what do you need to be putting aside into your business bucket to ensure that you can take from it as a drip in order to fill all of your personal buckets. And then fourthly, we need to set a business income target that ensures that you can have those accounts filling and basically making sure that we never deplete them down to zero or find yourself in a position where you're going to need overdraft in order to cover those cash flow shortfalls. The idea here is that good cash flow control is about appropriately forecasting and creating rules and frameworks, about actually action planning and on-track managing that cash flow so you can continue to optimize and improve. And thirdly, when things don't work, if there is a cash flow shortfall or that your plan hasn't gone to plan, that you can recalibrate your expectations to ensure that you don't have cash flow shortfalls into the future. This is all about having a perspective, finding out the reality, reflecting, and then optimizing and improving over time. This is what we implement for our clients of all shapes and sizes, whether they're just getting started in business and they're doing 10, 20, 30 grand a month, even up to 9-figure businesses. We implement the exact same system. Sure, there's more complexity, but the fundamentals are exactly the same. And this ensures that you can maximize your surplus and your profit to make sure that you can achieve more of your goals. Any questions? Let me know in the comments.